So next topic we are going to start methods for calculating national income. There are three methods we have where we can calculate national income. One is that value added method, income method and expenditure method. Now come to first is the value added method. Value added method otherwise known as the production method also or product method also. Product method means where that all the goods and services we are calculating, we are finding for calculating national income. Next one is the income method. Income method, it is that all the four factors income, that is land, labor, capital, entrepreneurship, that sense we are finding for calculating the national income. Next is that their expenditure method. In expenditure method, four sectors we are considering. Four sectors, they are household sector, firm sector, government sector and external sectors. Like that, the four factors we have: land, labor, capital, entrepreneurship, that should be considered here in income method, but here the sectors, that is household sectors, firm sectors, government sector and external sector, we are considering in expenditure method. Now come one by one, let's see that formula and how to calculate these things. One is that, first one is that value added method. When you are using first formula in value added method, that you can find GDP MP. I am telling you, in the value added method, the GDP MP otherwise known as gross value added also. Sometimes the question asking that gross value added, so don't be confused that it is nothing but the market price only. Okay, so now in gross value added or GDP MP in value added method, when we are calculating that GDP MP, only two things you should remember. One is that value of output minus intermediate consumption. But the things is, in the questions directly not given most of the time value of output. Value of output given in the form of parts, subparts. Let's see that what? One, domestic sales plus change in stock plus export. Remember that there, if domestic sales not given, only sales has given, that time if we considering it is the total sales, say it is given the total sales, that export will not include that time, because of in the total sales that export already included. So that's why it's given the total sales. So we should not consider again export. But if domestic sales given at the time, when the domestic sales given, that time export definitely should be included, because of that export part it is not included in the domestic sales. So that's why I have written optional. Optional means that where that the total sales given, export you should not consider. So these three things if you adding, it's become value of output. So value of output equal to domestic sales plus change in stock plus export. Otherwise total sales plus change in stock, it is known as the value of output minus intermediate consumption. Remember that where the intermediate consumption is given, purchasing of all raw material things, intermediate goods. Purchasing of all intermediate goods, it comes under the intermediate consumption, but not that purchase of fixed assets. Any fixed assets may be arise here, that purchase of fixed assets, say example machinery, furniture, any computer, this will not part of this intermediate consumption, even it is purchased. But it is not part of that, because it is not used for the intermediate goods or intermediate consumption. So that's why this part will be not included. But purchase of electricity, that also part of this intermediate consumption. Okay, so that value of output minus intermediate consumption. In value of output directly not given, we should consider domestic sales plus change in stock plus export minus intermediate consumption, purchase of any goods, raw material. Next, come here the in income method. When income method, first you are using that given you NDPFC. NDPFC otherwise known as the domestic income. Now one clarity I am giving you, that N, that is net, and FC, factor cost. Anywhere you find this net and factor cost, indirectly you can say this is the income also. How? Example, see. Say example, NDPFC, it is otherwise known as the mid one, that is domestic. So domestic income. Like manner, NNPFC, so N and factor cost, you can say that mid one, that is national income. I hope clear. So that it is domestic income where the net as well as factor cost domestic income, where the net as well as factor cost national, it is national income. That's it. Okay, now come here, this formula is little bit bigger, so concentrate here. So first one is that when NDPFC we are calculating, so here NDPFC equal to first is that compensation of employees, operating surplus and mixed income. Again, compensation of employees plus operating surplus plus mixed income. Now the question is, sir, directly if it is not given compensation of employees to you, what the things we should include there? So compensation of employees most of the time directly not given to you. At that time, that making of the compensation of employees, we should consider wages and salaries plus contribution to social security scheme. Remember that contribution to social security scheme, SSS, by employer. This point is little bit important, by employer, not employee. Remember that where that wages and salaries, definitely it should be there, then you should add it. And contribution to social security scheme by employee, that time you should not include this, by employee. But contribution to social security scheme by employer, you must be included, because of that if contribution to social security scheme by the employee given, indirectly employee earns some money in the form of salary and wages, and out of that money only that employee invested in the form of social security scheme, say pension scheme, some other provident fund scheme, these all comes under this social security scheme. So in this what, that wages and salaries already I have included. If I already have included, again I should not consider again that employees social security scheme here, double counting should be there. So that's why that social security scheme by employee should not be included, but employer given, that amount not to be included here in wages and salaries. So that's why we should include contribution to social security scheme by employers. And the last one is that retirement pension. Remember that retirement pension. The retirement pension also, it is a part of income of employment, and employment means the economic activities. So economic activities we are only including in national income, we know that. So that non-economic activities like old age pension or any other general pension has given there. Pension is not another activity, it is not at all any consideration. If you are old and you are getting some money, you have not done any work for that getting of that money, but you are getting. So that money is one-sided transactions only. One-sided transactions never be included in the national income. So that's why what is that? Retirement pension, it is a part of the national income, but old age pension or the general pension, it is not part of the national income. It should not be included there. So these three consist of the compensation of employees: salaries and wages, contribution to social security scheme by the employer, and retirement pension. Last one, where that operating surplus directly not given you. Most of the time operating surplus not given you directly. So at that time what should you do? That operating surplus consists of four things. What are they? That is the rent, royalty, interest and profit. How you should remember that RRIP. So rent, royalty, interest and profit. Now come here, the rent, royalty, interest. If you finding these three, no, this is actually, it is the part of these four factors only. See, the rent comes under what? Land. Royalty, it is a part of the profit. Interest, it is the capital. So indirectly if you finding no that land, labor, capital, entrepreneurship, these things only comes under here in NDPFC. Land, for that rent I am taking, labor for that wages and salaries already I have taken, for that capital interest I have taken, for the entrepreneurship profit I have taken. I hope clear. So that's why this income method we are considering land, labor, capital, entrepreneurship. That is income of the four factors. Okay. Now rent, royalty, interest and profit, if you adding you can find operating surplus. Sometime what happened, that profit also not given directly. So that if profit directly not given, that time what it would be give. So let's see that three things it could be addition make profit. One is that dividend, another one is corporate tax, and the last one is undistributed profit. Now you think why the profit categorized, okay, now you think that why the profit categorized into three parts. I am telling one by one. Say if a company earned a profit of rupees 100 rupees, out of 100 rupees, that company definitely would give the profit part to the shareholders. Say example 50 rupees company has given to the shareholder. This is known as that dividend. You know very well in accountancy where the profit part given to any shareholders, that is known as a dividend. Next one is that out of that some profit, some of the percentage, say example 30%, 20% as per the company's base, they will pay corporate tax, company's tax, or you can say that indirect tax to the government. So that is comes under corporate tax. So 100 rupees out of say 20 rupees given as a tax, remaining company not paying anywhere, company or the firm keeping itself for the future contingencies. So future contingencies is undistributed profit. So the profit can be categorized into three. So dividend, corporate tax and undistributed profit, consisting all three become profit. I hope understood. And the mixed income, otherwise known as self-employed income also. So now income method, if I am compiling all that things, so that income method NDPFC. So NDPFC equal to compensation of employees plus operating surplus plus mixed income. Clear? Okay. Now come here that expenditure method. Expenditure method, I already told you that expenditure method, it is the expenditure of all four sectors. Four sectors we are considering, and when first time when I am using the formula, that gives you GDP MP. Now I am compiling another summary wise. Say if value added method and expenditure method you are combining, no, that value added method and expenditure method gives you GDP MP only, but income method first time when you are using is gives you NDPFC. That is the difference. So in this GDP MP equal to, I told you the expenditure of that all four sectors. Let's see that all sectors how expenditure. Household expenditure is otherwise known as the private final consumption expenditure. Next, government expenditure or government sector, government expenditure says that government final consumption expenditure. Firm doing expenditure for the production purpose. So the production purpose, I can say that gross domestic capital formation. What is the capital formation? Capital formation, it is that additional of capital stock within a time duration. When the capital stock should be? Definitely, say example 2 years back you have 2 lakh rupees capital and the 2 lakh rupees you have invested. Now you have 3 lakh rupees. Because of that all profit you have included in that. So now capital how much you have? 3 lakh. So it is nothing but the capital formation. How much formation has done? 1 lakh formation has done, no? So this is known as the capital formation. How the capital formation has done? Definitely you have invested. And the firm doing investment only, we know that. So otherwise known as gross domestic capital formation, gross domestic investment also. So three things already done. Private final consumption expenditure by the household, government final consumption expenditure by the government, gross domestic capital formation or gross domestic investment by the firm, and external sector doing two things, import or export. So that is comes under the net export. Net export how should calculate? If directly net export not given, how should calculate? Simple, that net export, it is nothing but export minus import. X minus M, export minus import. Okay. Now Gross domestic capital formation also sometime not given directly to you. So at that time what should you do? Let's see that. Gross domestic capital formation equal to gross domestic fixed capital formation. See, what are the changes has there actually be found? Only at the place of fixed included. So that gross domestic fixed capital formation, for the removing of the fixed, I should take change. So for the removing of the fixed, I should take change. What change? Change in stock. That's it. So that gross domestic capital formation we need, if it is question not given gross domestic capital formation, we should take gross domestic fixed capital formation plus change in stock. That's it. Next one is that gross domestic capital formation, sometime it is given in the form of net domestic capital formation. So that net and gross, what is the difference between that? Net and gross difference is the depreciation. So that net domestic capital formation given to you, you should add depreciation with that. It's become gross domestic capital formation. Next one is that gross domestic capital formation, it might be given in the form of net domestic fixed capital formation. If you finding no, net also there, second part, fixed also there, first part. So that first and second both has given in the third one. So that net, for that net I should use depreciation like before. For the fixed I should use change in stock. So what should be here? Net domestic fixed capital formation plus depreciation plus change in stock. That's it. This is that all three formulas for calculating of national income. I hope understood.